Namaskar dosto. Hello friends, this is your friend Vivek Bajaj, Stockage and Elearnmarkets co-founder. Friends, this face-to-face is going to blow your mind. This is going to be very important face-to-face which I have recorded till date, particularly in the domain of investing and long-term wealth creation. In our life, we come across many people who inspire us. When we start, obviously, our parents are the primary source of inspiration. They guide us to do the things the right way. But then throughout our journey, we come across many people in person or virtually in some form who are inspiring us to do a lot of things. I've been a perpetual learner in my life, and I've always sought inspiration and learning from various people. And this face to face is all about getting inspired and getting trained from the right people. One of the person I met through his book a couple of days ago has really blown me away. His book is amazing. As a person, he is amazing. And he is doing some incredible work in the domain of investing and wealth creation. I requested him to come on board and share his experience and knowledge with my learners. So here I am with a super energetic and awesome Gautam Baid. Hi, Gautam.
Thank you for the kind introduction, Vivek. It is a pleasure being here. And let me congratulate you on doing a great service for the investing community in India through Elearnmarkets and the Stock Edge platform.
Thank you, Gautam. It means a lot for me, words coming from you. And more than anything else, I mean, you have written such a lovely book and you have such a strong wisdom of market. So if you believe I'm doing good work, then I will take it as a compliment that yes, we are doing reasonable work in the market. So Gautam, you know the format of face to face. We talk about you first, and I'm very excited to know more about you because you are from Kolkata and you have reached there, which makes me so exciting. So we'll know more about you for a couple of, and then we'll go deep dive. I know you have made a lovely presentation for us, and it's going to be a very long discussion. So दोस्तों अगर आप हिंदी भाषी हैं और आपको अगर इंग्लिश समझने में दिक्कत होगी तो हम लोग स्लो जाएंगे तो आप कोशिश कीजिएगा समझने की बिकॉज गौतम ऑब्वियसली हैज स्टेड इन यूएस फॉर लॉट ऑफ टाइम तो आपको ये अप्रिशिएट करना पड़ेगा कि गौतम इंग्लिश में ही ज़्यादा बोल पाएंगे बट वी विल गो स्लो और people who are watching us in English, if you feel like increase the speed of this video, YouTube has given facility तो इसको 1.25 आप कर सकते हैं so that you enjoy the whole learning process very well. So Gautam, here we are. Tell us about you. Very excited to know about you.
Sure. I come from a Marwadi family in Calcutta. And as you very well know, Vivek, the Marwadi community in India have got business and entrepreneurship in our genes. So ever since my teenage years, I was very fascinated by the concept of business and entrepreneurship, especially by the fact that once a strong foundation is established for a business, the owners do not work for money. Rather, money works for them. I did my graduation in commerce with a specialization in accountancy. So pursuing higher studies in the field of finance seemed like a natural extension. So I did my MS in finance from ICFI University, Hyderabad, India. And I also did my MBA in finance from Nirma University, India. And later on, I also went on to obtain my CFA charter from the CFA Institute, US. After my MBA program got over, I got a campus placement with Citibank in their Mumbai office as an investment banking analyst, where I worked for 3 years. And after that, I joined Deutsche Bank as a senior analyst in their investment banking team, where I worked for almost 4 years at their Mumbai, London, and Hong Kong offices. As regards how did I get my start in the stock markets and investing, like most new investors, and as is typical of most investors in the market, I was pulled into the stock market out of sheer greed during the final euphoric phases of a bull market. In my case, it was the 2003 to 2007 bull market in India. I still remember I had purchased a mutual fund named Reliance Power Sector Mutual Fund in late 2007 and a stock named Ispat Steel in January 2008, because both of them belonged to the highly fancied and hot sectors of power and steel at the time. And both of them had recently appreciated sharply in a short span of time. Now, what I did was I engaged in blind extrapolation of the recent price trends in them without paying any heed or attention to their underlying business or valuations. Within the first 12 to 18 months of my purchase, both those investments crashed 70 to 80%. And I had successfully gained admission into the stock market by paying my tuition fees. So as you can see, recency bias and vividness biases are very powerful but highly costly behavioral mistakes. Despite this bad initial experience, my interest and curiosity about the Indian stock markets remained very high throughout the first 7 years of my professional investment banking career. And one fine day, I came to the deep realization that we just have this one short life to live. And I did not want to waste any further time doing something that I was not truly passionate about. Many
Hmm.
people tend to confuse earning a high salary with job satisfaction. That is not the case. Success does not mean
Hmm.
earning potloads of money because there's only one definition of success: being able to live your life in your own way, living a life aligned with your value system. That is what success means to me. And I was so keen for a career shift that I immediately no, that I relocated to the US in May 2015 without any job in hand. I
Wow.
was I was under the impression that since I'm a CFA charter holder, then I'll easily
Hmm.
land a stock market job because this particular degree is highly valued in the investment industry. But
Hmm.
as you know, Vivek, life is not a bed of roses for those trying to carve their own destiny.
Right.
I got rejected in my first three stock market job interviews in the first 6 months in the US. At the same time, I ran out of whatever little money I'd brought with me from India.
Hmm.
And to take care of my living expenses in US, I did not want to sell a single share from my portfolio of Indian stocks because I did not want to interrupt the process of compounding.
Right.
So, to sustain myself in the US, I took up a minimum wage job as a front desk hotel clerk at a hotel in San Francisco, where I worked for 15 months.
My God.
And I used to work during the graveyard shift. Now, for those who don't know what the graveyard shift means, it
Hmm.
was the shift from 11 p.m. at night to 7 a.m. in the morning. Even though it was a big challenge for me intellectually, mentally, emotionally, and culturally, today I highly value those days of my life, Vivek,
Hmm.
because for the first time since the beginning of my professional banking career, I finally got some time to read and learn and invest in my personal self development. The pace of work during late night to early morning at the hotel was pretty slow, and I made
Hmm.
full use of the free time to read up every single blog article published from inception till date on blogs like Safal Niveshar, Fundu Professor, Jana WordPress, Basic
Hmm.
Investing, and Microcap Club, among others. And the passionate pursuit of lifelong learning had begun. Little did I know at the time, though, that I was laying down these strong building blocks for compounding in my life. Now, at this particular point, I would like to take a moment and talk to you about the power of passion because it is extremely important.
Hmm.
During those 15 months, every single night, I used to apply to a minimum of three stock market jobs online. And as you know, every time we take out the time to fill up the application,
Hmm.
attach the resume, and every single time we click on the submit button, there is so much hope attached behind
Yeah.
every single submission, right?
Hmm.
To face rejections more than 1300 times and still keep on going is only and only possible if you're absolutely passionate, fiercely passionate, and sincerely dedicated about
Hmm.
what you want to achieve in life.
Hmm.
So that is what I want to convey to all the learners of our channel, that never ever give up because compounding will bestow its benefits and magic upon you only after a very long time,
Hmm.
after testing your patience and conviction to the fullest. Now, luck, chance, serendipity, and randomness have always played a big role in various aspects of my life till date. During November 2016, during one fine night at the hotel, I randomly clicked on the quick apply button
Hmm.
on a particular job application on LinkedIn, and
Hmm.
wonder of wonders, I got shortlisted for the interview, and that too for a senior role in an investment firm, even though I had zero formal stock market work experience.
Hmm.
And this was the phase in my life during which I was about to realize the power of compounding knowledge in action.
Hmm.
All those hundreds of hours spent over the last 15 months reading those blog articles and white papers and investing material at the hotel had now built a very strong intellectual foundation for me in investing.
Hmm.
This is what I was lacking during the first 6 months and those three stock market job interviews. And I was able to excel in all the three rounds of my job interview because, as you know, body language derives from self confidence and self confidence derives from knowledge. And
Hmm.
I was offered the role of portfolio manager.
Oh my
And
God.
it was something beyond my wildest dreams because I never ever imagined in my life that I'll be hired as a portfolio manager at such a high
Hmm.
pay scale. I thought I'll be hired as a junior analyst, then I'll work as an
Hmm.
analyst, and then senior analyst, and then assistant portfolio manager. Then finally, maybe I'll reach this the level of portfolio manager in 14, 15 years.
mm,
But
mm.
this is what happens when we just keep on persisting, never give up. Magical things tend to happen. Around the same time, something even more incredible happened. I joined Twitter in November 2016, and I
Mm.
started sharing my thoughts, whatever interesting material I was reading, whatever were my thought process on philosophy, psychology, history, investing. I started sharing all of that information. And within a few months of my joining Twitter, two individuals flew all the way from India and came down to Salt Lake City to meet me and thank me
Wow.
for what I was sharing on Twitter. And it was a very humbling experience. And they were the ones who suggested to me the idea of writing a book. Why don't you write a book, Gautam? We love what
Oh.
you're writing,
Mm,
what you share. And I always had this habit of curating content and just noting things down in a Word document over the years. So I thought, why not organize all this material into a book format?
mm,
And writing about and sharing my life's biggest learnings was my way of giving back to the investing community from whom I've learned so much over the years. So I self-published the first edition of The Joys of Compounding out of my own pocket, and
mm,
I sold it for zero royalty. I did not charge any month profit to cover for the costs of production, marketing, distribution, or logistics, because the only intention was to help people. That was the only simple intention, just to give
mm,
back to society and give back to the community. But the beauty of this world, Vivek, is that when you help others unconditionally without
mm.
expecting anything in return, the universe works in such a way so as to come back and reward you back multiple times over.
True.
In May 2019, when I was at Creighton University, Omaha, signing copies of my book for readers during the Berkshire Hathaway annual meeting, Miles Thompson of Columbia Business School Publishing flew down from New York to Omaha to meet me, and he offered me a publishing contract with them. And
Wow.
the rest, as they say, is history. Today, The Joys of Compounding is an international bestseller in 5 countries: Singapore, Canada, India, Brazil, and the UAE. And and what the success of this book has done is it has brought me on the radar of many technology startups in Silicon Valley in America. The
Mm,
last 12 months, many of them reached out to me to collaborate with them and join them on their platform. But I
mm.
decided to go with Chapter, which is a curation-based learning platform where I teach the discipline of investing.
Yeah.
I decided to choose Chapter because the mission of the founders, Kyle and Steve, strongly resonated with me.
Mm-hmm.
The founders of Chapter are on a mission to make highly specialized education and learning affordable and accessible to the masses around the world.
Mm,
And the idea is to make the entire world a community of lifelong learners. So that their mission really resonated strongly with me. So I quit my job at Summit Global Investments as my portfolio manager job. I quit that at the end of July, just 4 months earlier.
mm-hmm.
And earlier this year, I had also set up an investment firm in India, Stellar Wealth Partners Private Limited. We
Mm-hmm.
applied for a corporate research analyst license to SEBI, and recently we were approved. And we are launching our small case on 6th of December. So through the small case initiative, I aim to build generational wealth for many families in India over the next few decades. So this, in brief, is my background, Vivek.
Awesome, awesome. I think you are not just a market person, you are a boy next door who should inspire the youngsters. And let me just tell one thing to my learners that I've read Joy of Compounding. I'm almost at the fag end of the book because I've used it as my life textbook. I have not just read it for the sake of reading. Every day I have a target of reading certain number of pages. And this book is not about only investing. This is about life compounding. So people who probably didn't realize that I mean, typically compounding is a word used for investing, but let me clarify here that this book is a life compounding. So all of you who have not read this book yet, who have not purchased it, uh, you have to read this book. You have to give this book to your youngsters and family. The earlier people start reading this book, the better they will compound in their respective life. So Gautam, thank you so much. It's been a great knowing you, and I hope you just keep growing and growing and growing and emerge as the next big thing India has sent to global markets. So let's get into your presentation because you have lots to talk there as well. So let's deep dive into your presentation. I think you can share your screen.
Sure. So today I will be speaking about the discipline of investing. And before I begin the presentation, just a standard disclaimer that this presentation is solely for information and knowledge sharing purposes. The examples shown are for understanding concepts and should not be considered as stock recommendations. Stellar Wealth Partners is a SEBI registered research analyst firm. We may hold some or all of the discussed stocks from this presentation. in our proprietary accounts or small case model portfolios, it is also possible that we may have exited or may exit from the stocks in future without prior notification. So please do your own research and due diligence for any investment actions and consult a registered financial advisor for the same. Stellarwell Partners will not be liable for any claims arising from use of data provided. Neither is there any guarantee for accuracy of data. And most importantly, the views expressed are my own personal views and do not represent the views of any entity or organization.
Thank you.
So this will be the flow of today's presentation. I'll be taking everyone through my investing framework and explain the investing framework through the use of case studies, both past and present from the Indian stock market. And finally, I'll finish the presentation with a brief about how value investing is a life discipline. So all successful investors in the world have a very clearly defined investment philosophy. That investment philosophy in turn is defined by vicarious learning from other people through books, through personal experiences. These are some of the books which have defined my personal investment philosophy. Terry Smith's Investing for Growth taught me how to invest in high quality growth businesses for the long term. Capital Returns, which was edited by Edward Chancellor, taught me the capital cycle theory and the use of it when investing in cyclicals and commodities. And Joel Greenblatt's classic on special situations, You Can Be a Stock Market Genius, taught me how to evaluate demergers and reverse mergers. We'll discuss all of this in the presentation today. This is a brief snapshot of my investment process flow. There is always an existing list of ideas on my watch list and I keep tracking the performance of those watch listed ideas, and I keep checking for management execution and business performance. And to that existing watch list, new ideas keep getting added from time to time through an idea generation process, which we'll discuss shortly after this slide. And then this leads to an active watch list of 10 to 15 potential opportunities, which in turn feeds into the portfolio construction and the portfolio tracking and rebalancing. So let's cover those two aspects first.
Okay.
The portfolio on an average comprises of 20 to 30 stocks, and the aim for me at any point of time is to generate 20 to 25% CAGR on a portfolio level over the next 3 years. I follow a sector and market cap agnostic investing approach with a bias towards under-researched and well-run small to mid-cap companies. There is no hard cap on contribution to the portfolio from any one single idea or sector or market cap range, but I ensure that prudence is maintained at all times. The initial weighting per stock ranges from 3 to 5% at cost, and the occasional exceptional opportunities may get an allocation of 10% at cost.
Okay.
The decision to sell any single stock will solely be based on their business performance or their potential incremental IRR or the potential returns from the current price. And I keep a portion of my portfolio in cash if valuations of existing holdings or the watch list ideas become exorbitant. I track industry trends of my portfolio companies like changes in the competitive landscape, any technology changes in government regulations, any supply chain disruptions. The quarterly results are evaluated against my own expectation, and the performance is benchmarked against that of competitors. And a detailed diligence is carried out in case the investment performance is not as per the initial investment hypothesis.
Okay.
Any particular holding is exited only if the valuations become absolutely expensive or if there is a structural challenge to its business fundamentals. And all the portfolio companies are periodically ranked based on valuations, earnings performance, expected future stock returns, and the rebalance is done accordingly. Any fresh or follow-on investment in an idea is done only if it can deliver an attractive IRR of 20 to 25% over the next 3 years from the current price.
Okay, just one small thing. Gautam, I'll keep on asking questions in the middle if you allow me to do that.
Sure.
Yeah, so when you say 10% at cost, that means every time you evaluate allocation in a stock, that will be always at a cost price, not at the current market price.
When I initiate the position, yes, because that will determine the initial weighting, right?
Okay, and suppose you are reviewing everything probably every quarter, then do you do mark to market, or it is the percentage is always at a cost?
So once the stock has been purchased, then the ratings are all evaluated based on the current market price. This when I say initial allocation at cost, it means that I'll give an example. Suppose I have a portfolio of 100, of which 90 is invested and 10 rupees is in cash. So if I allocate that entire 10 rupees into the portfolio, into a new stock in the portfolio, that means that it has got an allocation of 10% at cost. That is what it basically means.
Sure.
But once the
Got it.
initial allocation is done, once the initial purchase is done, then all the stocks are looked at based on current market value. The market value weights are considered after that, after the
Sure,
initial purchase is done.
sure. Got it.
So now we come to the main crux of today's presentation about how do I generate ideas? What is the sources which are used for idea generation? Because a lot of people ask me, what are the sources which you use for generating your ideas? And today I would like to share that in detail with our learning community.
Awesome.
So every day I diligently review all of the corporate announcements on the Bombay Stock Exchange. It is a painstaking exercise for many, but for me, it is like an intellectual treasure hunt wherein I may strike gold anytime. And I look at press releases, investor presentations, any M&A deal, joint venture or partnership agreements. Whenever I'm evaluating quarterly results of companies on Screener or any other database, I try to look out for breakout earnings. What does breakout earnings mean? It means sales have basically grown more than 50% year on year. Profits and earnings have grown more than 300, 400% year on year. That is called an earnings breakout. And the stock market is very slow to adjust the stock price to the right intrinsic value immediately. So you get what is known as a post earnings announcement drift. Even if you buy these stocks the next day after their earnings report, the previous night, even if you buy them 5-10% higher, that is not the correct intrinsic value. The intrinsic value actually is much higher. But the stock market takes its own sweet time to revalue the stock to the right high level. So watch out for breakout earnings when you're evaluating quarterly results. I also go through con calls of all the existing holdings as well as the watchlist ideas on Trendline, Alpha Street, Research Bytes. And in case of certain micro caps, you can also get their conference call transcripts by going to the company website, investor relations section. I also check what are the global peers are saying. What is their commentary? What is their outlook? This is especially important in commodity industries and chemicals and cyclical businesses like chemicals, because many Indian promoters have a tendency to make very overly bullish statements. So it's very important to corroborate that with what the global peers are saying. Also try to read as many management interviews as possible of all the watchlist companies and the portfolio companies. This can come from various sources in business magazines or articles on the internet or business channels. I use screening tools like the Jory Finance and Screener, and in that I look for companies which are either undergoing a very big capex program or companies which have already completed a very big capex program. I also look for a list of stocks which are hitting 52-week high, all-time high, or a post-IPO new high. Now let me emphasize a bit on this last point about post-IPO new high. Many times in the Indian market, you'll notice that companies get a very big listing pop, and then they go into consolidation for 8-9 months or 10 months or more. And then they again break out after that long period of consolidation. And that breakout after that long period of consolidation generally coincides with some important corporate development in that company. So always be on the lookout for a post-IPO new high. And one more very important point I would like to share with all our learners here is that when you're evaluating price action, time frame matters. So immediately after a bear market crash, look for stocks which are hitting a 3-month or a 6-month high. In a mature bull market, which is in late cycle, look for stocks which are hitting multi-year highs. In a non-trending, range-bound or sideways market, look for stocks which are breaking out to 52-week highs. So time frame is very important when you're evaluating stocks hitting highs. Just keep that in mind. I also go through equity research reports. These are some of my favorite broker names whose equity research reports are pretty informative. Ambit, ICICI Securities, Spark Capital, India Infoline, Nirmal Bank, and Axis. I go through the annual reports diligently every year, and credit rating reports are also very, very important because they are a rich source of information. Now, on the credit rating reports, I would like to make an important point here that for many macro cap companies, which have got loans outstanding or may have taken loans in the past, these credit rating reports are often the only third-party source of information available to you in the absence of conference calls and presentations. And you'll find such information in those credit rating reports of those macro cap companies, which you cannot find anywhere else. So pay attention to credit rating reports. DRHPs or draft red herring prospectus and QIP offering documents, both are a very rich source of information on any particular industry. As an example, if you want to learn about the music licensing industry in India, you can read the recent QIP offering document of Sargama Limited. So these two documents give you very rich source of information on a particular industry.
Mm.
I also read the investor letters by fund managers whom I admire for their investment philosophy. Some of them
Mm.
are Solidarity, Sage One, and Equirus. They publish very good investor letters. I also try to attend investing conclaves like Tamil Nadu Investor Association or India Investing Conclave,
Mm.
and webinars like those held by SYC.
Mm.
A less talked about source for idea generation is the uh, fund managers top 5 holdings from PMS Bazaar website. Now,
Mm.
the sign up is free, but very few people know about this particular source. You can actually log into this website and get the top 5 holdings and weights of fund managers whom you admire and respect
Mm.
in the stock market in India. So this is a very good source for idea generation.
Mm.
And thanks to you, Vivek, and thanks to the Stock Edge app, that's a great source of idea generation through information on bulk deals, block deals, and insider buying.
Mm.
And I also look at the 52-week high volume list on a daily basis, because anytime a stock experiences a 52-week high volume, something generally tends to be happening in that particular company. It can be on the upside or the downside, but something interesting is happening. So then I start looking up the news articles on that particular company. What has exactly happened in the last 1 month?
Mm.
I read magazines like Forbes India, Fortune India, Outlook Business, and I read newspapers. I read the digital edition of Economic Times. I also go through industry specific websites. Like, for example, for chemicals, you have got Chemical Weekly. For steel, you have got Steel Mint. For commodities, you have got Platts. So I have a list of industry specific websites, which I go through as well. And the next point is a very common one. We have daily discussions with our peers and colleagues in the Indian stock market. I also look out for views of the leading analysts of individual sectors. Social media platforms like WhatsApp, Twitter, Telegram channels are also a good source for sourcing ideas. And I also read online forums like Value Picker and Multiply. Now, I would like to ask our learning community one question. Just think and ask yourself, if you go through all these sources on a daily basis for the rest of your investing career, how can you not help but become successful? If you follow this particular list, you will be literally flooded with great ideas all the time. But you have to be unreasonable, like I write in my book. You have to be very demanding in your hurdle rate for incoming investments.
Yeah.
You have to differentiate between the very good ideas and the excellent ideas. And like Warren Buffett has said, the difference between the successful people and the very successful people is that the very successful people say no to almost everything. You have to learn to say no, go through all these sources, and then only invest your hard-earned money into exceptional opportunities or opportunities which can give you very high returns from the current market price. That is a discipline which you have to maintain at all times. So just wanted to highlight that. That's very, very important.
It's a great checklist. I wish people take a printout of this checklist and put it in front of their desk.
Well, Vivek, that is, in investing, the person that turns over the most rocks wins the game, like Peter Lynch has said.
Yeah.
In life, relationships, business, or investing, nothing will work unless you do. And the more rocks you turn over, the more ideas you'll get. And then you simply have to pick the best out of those opportunities which you come across. That is the whole idea. There is no alternative to hard work. But the stock market is a place where if you put in the hard work on a daily basis, you will be highly successful over the long term. That I can tell you with high conviction.
True. Great.
Now, this is possibly one of the most important slides in today's presentation. All the great investors in the world have one single common attribute: a relentless focus on the underlying process. Because investing is a field of probabilities. Investing is a probabilistic activity. And Michael Mauboussin has penned some gems on this in the past, and I quote, "In a probabilistic environment, you are better served by focusing on the process by which you make a decision than on the outcome. We have no control over outcomes, but we can control the process. Of course, outcomes matter, but by focusing our attention on process, we maximize our chances of good outcomes." Numerous research studies have identified a common trait among successful professionals in fields of probabilistic activity. They all emphasize process over outcome. If you focus only on the outcome, you are less likely to achieve it. Instead, if you focus on adhering to a sound process, the outcome will take care of itself in the long term, although the short-term results almost always will be driven by luck. Over the long run, a sound process can be counted on to deliver desirable results in a sustained manner and produce more reliable outcomes. And I'll keep referring back to the slide for the remaining presentation, because this is very, very important. Investing success is obtained by stacking multiple layers of positive probability in your favor.
Mm.
I follow a multi-pronged approach for idea generation. One of the approaches is tracking key company metrics and investing in leaders in niche sectors with low competition, healthy balance sheet, high return ratios, good revenue growth. I also track the investment activities of uh, private equity funds, hedge funds, mutual funds, and investors whom I admire and respect. And I check for insider buying as well. I track industry developments like sectors undergoing supply side consolidation. Here, a good example is the Indian real estate industry, which has undergone a major supply side consolidation in the last decade. I look out for any favorable or adverse regulatory changes in any sector. And I also look for emerging sectoral adoption trends. Now, here a good example would be the music streaming industry. Basically, technology has changed our music consumption patterns from audio cassettes and other forms of media to consuming content on platforms like YouTube, Savan, Ghana, etc. But one of my favorite sources for alpha generation is tracking corporate developments. In this, we have change in promoter management, block deals, merger arbitrage, demergers, and significant capex. Let us go through some of them with the help of case studies from the Indian stock market.
Awesome.
First, change in promoter and management. So last year in August, Murugappa Group announced the acquisition of CG Power. And it is important to understand the background to this particular transaction. In 2019, CG Power was hit with the 3,000 crore rupee fraud, and the stock had basically got hammered out of shape. And last year, in August last year, the stock was trading at sub 10 rupee level. The moment Murugappa Group, which is highly respected in the Indian markets for their high standards of corporate governance, took over CG Power, from that day till date, the stock of CG Power has given more than 1,000% return already. And what this case study is meant to demonstrate what happens when a company with low perceived standards of corporate governance is acquired or merged with a company with very, very high standards of corporate governance. So this is a case study from this particular case study is basically broadly played out from the past. Now let me use this particular learning to a live case study.
Okay.
In August last year, Embassy Group announced the merger of Indiabulls Real Estate with itself, and Indiabulls Real Estate the promoters would be exiting the real estate business, and the newly merged entity would be called NAM Estates. In this particular merger, only the NCLT approval is pending now, so the merger should get completed in the near future. Now, a few slides earlier, I talked about stacking multiple layers of probability and stacking the odds in our favor, right? Let me explain with the help of this particular case study what's happening. Number one, once the merger is completed, the corporate governance discount which was being applied to Indiabulls Real Estate goes away. So you get valuation re-rating. That's number one. Number two, Indiabulls Real Estate is primarily in residential real estate, and Embassy Group is primarily in commercial real estate. Indiabulls Housing has got a prominent presence in West India, and Embassy Group has got a prominent commercial real estate presence in South India. Now, once these two entities merge, you'll get a pan-India real estate behemoth, and you'll get a much better valuation for that particular combined entity. So that's point number two. Point number three, the chairman of Embassy Group, Jitendra Virwani, is a highly respected name in the Indian real estate industry. And once this merger is completed, the new entity, NAM Estates, will get a valuation premium for the superior management quality and execution under Mr. Virwani. And point number four, and most importantly, we are, after almost a decade, experiencing a boom in India's residential real estate. And over time, and generally commercial real estate follows with a lag. I think we have got multiple tailwinds in place, and the setup is very, very promising for this particular company from this point onwards. I think the stock has already more than doubled in the last 1 year, but I think we are just getting started here.
Okay.
The next source of idea generation is what I call block deals. Now, sometimes in the stock market, you'll observe that a company reports a blockbuster quarterly earnings report, but the stock price does not react. In fact, the stock price probably stays sideways or goes down. Why does that happen? It happens because there may be an institutional shareholder or an institutional investor who is looking to exit. It can be for any reason. He may be looking to meet an investor redemption, or a new fund manager may have taken over the fund and he wants to just get rid of this particular stock and move on to other ideas. It can be a plethora of reasons, but as value investors, we only focus on the underlying business and the
Mm,
valuation, right? When on June 15th, it was notified to the exchanges that Templeton Strategic Emerging Markets Fund had sold 2.36 lakh shares of Global Spirits at 430 rupees per share on the NSE.
mm,
And like I wrote in my book as well, whenever someone sells in desperation, they tend to sell cheap. And as a buyer, I love to be on the opposite side of such trades in which the other party is being forced to liquidate holdings at any price, regardless of underlying value.
mm,
This is how you get the bargains when there is a distress sale going on. From June 5th, after June 15th, once the selling pressure was completely absorbed and the stock was free to chart its own course, the stock of
mm,
Global Spirits went on to give more than 200% returns over the next 5 months before paring some of its gains in the recent market correction.
mm, mm,
The next source of idea generation, which I use, is known as merger arbitrage.
mm,
In the 1946 issue of the Analyst Journal, Benjamin Graham had penned a seminal article on special situations in which he wrote, in the broader sense, a special situation is one in which a particular development is counted upon to yield a satisfactory profit, even though the general market does not advance. And he concluded the article by saying that a special situation is an expected corporate development within a time period estimable in the light of past experience. Earlier this year, on 24th January, I tweeted about the merger of Harita Seating with Minda Industries.
mm,
Under the terms of the merger, every shareholder of Harita Seating would receive 1.52 shares of Minda Industries. And in case he did not want to go for the shares of Minda Industries, he would get preference shares worth 485. So again, I go back to the slide on process and stacking the odds in our favor.
mm,
What exactly happened here? Let's understand. If you're a shareholder of Hita Seating and if you're getting 1.52 shares of Minda Industries, then the value comes to 508, which was the current price of Minda Industries as of that date, multiplied by 1.52, which comes to 772.
mm,
But people who talk about efficient markets should see this. The
mm,
current price of Hita Seating on that day was 534. So you could have basically got literally risk-free returns of 40% in a few months' time, and you could have gotten paid just for waiting. On 4th February, just 2 weeks after, 10 days after that particular tweet, Minda Industries reported great set of numbers. And
mm,
if you notice what was happening here, for every 10% up move in a Minda Industries stock, if you are an investor in Hita Seating, you enjoy 15.2% appreciation because of the merger ratio. And this was a special situation in which you're just getting paid for just waiting. The very next day, on 5th February,
mm,
the merger came one step further closer to completion, and only the Chennai NCLT order remained pending. The merger got consummated and completed on 9th of April, and Harita Seating shares were delisted from the stock exchanges at a price of 766. What was the price on 24th January? 534. So in less than 2.5 months, you could have basically made more than 40% returns with very high degree of probability, high degree of certainty. You just have to be patient. Now, having understood how a merger arbitrage works,
mm,
let me share two live case studies and two exercises for our learners. Earlier this year, in February, APL Apollo announced the merger of Apollo Tricord with itself at a 1:1 merger ratio. Check out the current stock prices of both these companies, APL Apollo and Apollo Tricord. You'll notice something interesting. In a similar vein, in July this year, Equitas Holdings announced the merger of Equitas Small Finance Bank with itself at a merger ratio of 2.26. So basically, if you are an Equitas Holdings shareholder, you'll get 2.26 shares of Equitas Small Finance Bank. Again, check out the current stock prices of Equitas Holdings and Equitas Small Finance Bank using this merger ratio. You'll notice something very interesting.
Tell me,
The next,
Gautam, just one thing I want you to understand in that market, obviously the guys who are finding out the ratio, when a company is coming out with that merger ratio, they know the current market price of both these instruments. Why do they have a different kind of a merger ratio which gives an arbitrage opportunity to people? Why
the
can't they
arbitrage
do it in the current market price?
the arbitrage opportunities is basically coming from market inefficiency. So, as a very simple example, I'll just give you a simple example.
Mm,
Suppose A is merging with B at a 1:1 ratio, and if the merger is expected to get completed in the next 2 months, But if the stock price of A is trading at 1,000, while the stock price of B is trading at just 800, you basically get to earn 25% return just for waiting. And this sometimes, prices get out of whack because, and why is this arbitrage opportunity possible? Because the market fears that the merger may not go through because all these mergers have to go through regulatory clearances. But ultimately investing is a field of probabilities, right? You are simply trying to put the odds on your side. It is very, very rare for any of these mergers with of good companies to fail or not go through. So just a few months ahead of the merger, it's a good idea to actually shift from the overvalued, from the higher priced company to the lower ticket size company, because then you get a clear profit on the table. I gave two live examples right now. You can, once the all our audience goes through the stock prices, they'll notice an interesting discrepancy in the as based on the merger ratio. And this is how opportunities arise. Many people do not want, the market is full of so many people who are craving for instant gratification that they don't want to wait for even 2-3 months out.
Yeah.
And a bull market tends to spoil many people into thinking that 20% returns in 2 months is very, very below average returns. Fact is, when you stack up all those returns over the full year, when you engage in 2-3 such opportunities throughout the year, and when you compound those returns, it actually turns into a very large number. The key to compounding is to just keep going, keep churning out of the special situations from one into the other, and just keep on compounding. Over the long term, we'll end up with a very, very handsome CAGR.
Got it. Got it. So basically, you still have the risk of that M&A not going through. So how do one track, say I did buy the share and the M&A closure is probably 2-3 months down the line. So so a person should track all the corporate announcements of that company religiously to track what is happening with that M&A, because company can come out and say that no, we have called off the M&A, and that will have an impact on the stock price, right?
Yes, it will. It will. If the merger, for example, if the merger, if, like, I'll give you a good example.
Hmm.
In the India Bulls real estate example I gave you, suppose the merger does not get NCLT approval. Most of the run up in India Bulls real estate stock price over the last 1 year has been in anticipation of this merger happening, right?
Right.
If the merger fails now, then you'll again get the derating in the India Bulls real estate stock, and it will again start falling down to very low levels. So that is always a risk. But if you set up a Google alert on those two companies, if you set up a BSC, if you go to bscalerts.in and set up a alert for all the corporate announcements, if you're always on top of the developments, so you'll be able to take timely action in case of any adverse developments. So that's why investing is a full-time activity, right?
Sure, got it, got it. So technically, it's a time arbitrage which people
Yes.
will enjoy. I mean, yeah, got it, got it.
The next source of idea generation is of companies which are completing a significant capex. Now, this is a snapshot of a company taken from Screener. This particular company provides a critical input to the aluminum industry. And if you carefully notice what has happened here, the gross block or the fixed assets of this company have doubled from March to September, more than doubled, right? And in the past, if you look at the return ratios of this company, this is actually a pretty well managed company. In the past, it has generated return ratios, ROCs of 33%, 28%, 29%. But in the financial year ending March 2021, they reported a small loss. So if you're just running a mechanical screener, looking for only profitable companies or companies with net profit more than zero, you will never be able to catch these kind of opportunities. Now, you may want, what you need to know in this case is do a deep dive and get to know why this company reported that loss. The reason for that was they basically shut down their existing plant to synchronize with their new plant, and the existing plant was shut for 6 months. So for 6 months, they incurred no revenue. They basically generated no revenue, and they incurred all the fixed cost. That is why they reported a net loss for the year. But now the new capacities has come on stream. Now the revenues and profits will start coming in from the new expanded capacity. And again, like I just said a short while earlier, the market is full of participants wanting instant gratification. They didn't want to wait for this company to start reporting numbers from the new capacity. They beat down the stock. The stock basically fell 50% from its 50-week high. Again, how am I stacking all the probabilities of success in my favor? See, ultimately, it's a probabilistic activity. So even after our best efforts, we may go wrong, but all that we can do is try to follow a good process. The end user industry of this company, the aluminum industry, is doing very well. This company has got a healthy balance sheet. It has got a track record of having good ROCs. the capacity has expanded, and you're able to buy this at a 50% lower market cap. So when you combine all of this together, the probability of success is pretty good in my opinion.
Sure.
You know,
Uh, Gautam, I'm going to ask you stupid questions also. Please pardon me if you feel it's a very trivial question. But
please.
tell me, how do you come to know that the company has stopped the factory and they are doing this with the new factory? Is it the management commentary which mentions all these things?
Yes. So in their quarterly results published on the BSC, in the footnotes to the accounts, it's actually
Hmm.
mentioned just below
Oh,
the
okay.
profit and loss on the balance sheet. In the footnotes, they actually mention all this information.
Oh, okay. So that means not just by looking at the numbers, you also have to look at the footnotes of the results, which most of these platforms we don't capture that. But for that, obviously, one needs to download the PDF and see the footnotes.
Correct. And basically, this is again the advantage of maintaining an active watch list. So this company was in my watch list of companies. If you remember in the slide on sources of idea generation, I told you
Yeah,
that I look out for companies that are either undergoing a big capex program or
yeah.
have completed a big capex program. So
Hmm.
this company was on my radar from the time it was undergoing the big capex program. So I simply set up a Google alert or a news alert on this company. The moment the quarterly results came out and the communication came out from the company about what is exactly why did they report the loss, I knew that okay, this is a temporary loss. Now things will look up from here, and ultimately investing is all about the future. Whenever you're investing in any company, you're only concerned with the future trajectory of the business, up or down. That's all that matters, right? So now that the worst is behind this company, all the loss has been incurred, the synchronization of the new plant with the old plant is complete, with all the difficult phases over. Now it is time to reap the benefits.
Okay, that's point taken. Gautam, one small thing I wanted to inform you that in Stockage you can create your own watch list, and all these corporate informations you can get filtered with respect to all these watch lists in that section itself. Very interesting feature. If I don't know whether you have seen it or not, but it could really help you in getting the filtered corporate information for your watch list stocks.
That's very helpful information. I'll definitely check it out.
Okay.
So using a similar example again, this particular company has also more than doubled its gross block from March to September. This company also has got a track record of good, uh, efficient operations, as evidenced by their ROCE of 32%, 34%, 34%, and 24%. But this company also reported a small loss for the latest financial year. That
Hmm.
is because this company's industry has been badly affected by COVID.
Hmm.
So if you have the conviction that over the next few years, humanity will prevail, will come out with more improved vaccinations,
Hmm.
vaccination prevalence will increase, and life will get back to normal. This company will again get back on track.
Hmm.
But no one is interested in this stock right now because there are no earnings to show, right? There is because this industry has been badly affected by COVID and the lockdown, so they are not able to report good numbers at present. But
Hmm.
the new capacity has come on stream on 27th September, and on the total combined capacity, old plus new, this company is currently operating at less than 20% capacity utilization. Can you just
Oh.
imagine the amount of
Hmm.
operating leverage which is in store for this particular company?
Hmm.
Now, this is again a case where market players displayed their desire for instant gratification. They
Hmm.
punished the stock down more than 52% from its 52-week high. So again, you have got the probabilities on your favor here. This
Hmm.
company has got a fast track record of efficiently running its operations. Gross block has more than doubled. Promoter holding is pretty high. Promoter has got a good reputation in this industry, and the company is in store for massive operating leverage in the future. And you're getting it at a very depressed market cap and low valuation. This is deep value investing at its finest. You basically buy stocks when they are out of favor and they
Hmm.
have completed a big capex program. Then you just patiently wait for the cycle to turn, because
Hmm.
in most stock markets in the world, majority of the companies and businesses are cyclical in nature.
Hmm.
Most of investing is cyclical in nature. There are very rare companies which have got secular long-term growth. Mostly it's a field filled with cyclical companies. So the key to success in cyclical investing is to buy at depressed prices, depressed valuations and market caps, and then just patiently hold on. So
Sure.
I think even this particular company can surprise on the upside in the next few years.
Sure. Just one thing in this company is the debt going up. The overall debt level is now 168. So obviously that means that company has taken a lot of borrowings to incur the
Mhm.
capex. So that doesn't bother you?
Basically, I look at debt. No particular number in investing should be looked at in isolation. You have to always look at things. You have to look at. You cannot look at debt. You have to look at debt to equity. And when you
Okay.
look at debt to equity, it is less than half. Number one.
Okay.
Number two, you also look at the cash flow. More than debt, what you should look for is the interest coverage ratio, or the interest, whether the company can service its debt very very comfortably, which this company can.
Hmm.
So that in this case is not a problem. Everything
Okay.
is context dependent in investing. Uh, we cannot look at individual numbers in isolation.
Got it. Got it.
So you will always take one of these four risks when you buy a stock: a business risk, management risk, valuation risk, or industry risk. And there are only four things that can happen in investing. You'll either make a big profit or incur a big loss, or you'll make a small profit or you'll incur a small loss. If you can eliminate big losses, you shall do very well. There is no bigger mistake in investing than holding on to your losers for a long time.
Hmm.
Going wrong occasionally is perfectly acceptable. Honest mistakes are perfectly fine, but staying wrong after recognizing them, that is not acceptable.
Hmm.
In investing, what not to do is more important than knowing what to do. And there are certain things which I strive to avoid as an investor, namely investing in commodity and cyclical businesses near the peak of their cycle at peak margins,
Hmm.
investing in government owned companies because the promoter's key motivation is not wealth creation for shareholders, investing in project based businesses dealing with government tenders because these companies tend to have very weak cash conversion cycles and very high receivable days. I also try to avoid investing in melting ice cubes, or what I call value traps. These are basically companies which look optically cheap on PE and price to book, but are in reality very expensive because their underlying business is in decline. So you'll buy it at what when you buy them at a low PE, that PE ends up becoming very high because the earnings start falling very, very sharply. So avoid investing in melting ice cubes.
Can you
I
give
also
an example, Gautam, any stock name apparently which comes into your mind right now?
any company, I'll give you a good example here. So any company which can get disrupted by technology is a good
Hmm.
example. So for example, very good example here is the print newspaper industry in India. For
Hmm.
many years I've been hearing how they are trading so cheap at such cheap multiples, but the
Hmm.
fact is that the world has transitioned to digital, so
Hmm. Hmm.
that they were not able to reinvent themselves, and therefore they declined, and that was a classic value trap. Similarly, if any particular OEM or auto manufacturer does not adapt itself to the upcoming electric vehicle boom in India, they'll get left behind in a big way. So if you look
Hmm.
at them currently on price to earnings or any multiple and you find them cheap, if they don't transition or pivot to the electric vehicle industry, they may basically become obsolete in the next 5 to 10 years. So they are a classic example of value trap. I
True.
also venture. I also avoid venturing outside my circle of competence, driven by the lure of quick short-term returns in bull markets. Now, this is a very bad habit which I used to have in my initial years. That just because a stock was running very fast or very sharply and it was going up very quickly in a short span of time, I used to get attracted by the stock price rather than looking at the underlying business. Even if I didn't understand the underlying business, I thought I'll just buy the stock and sell it at a profit and then move on to the next stock. That
Hmm.
was the absolute worst approach to investing, and that's a short way to failure. So do avoid doing that. And this all the bad habits are inculcated in bull markets, and the prices are paid in the subsequent bear market. And I've paid my fair share of those price in the past. So I would just advise everyone to avoid doing that.
Hmm.
One peculiar problem with most Indian companies is that they have bad accounting quality and low standards of corporate governance. So I try to the maximum extent possible. I try to avoid investing in those companies. And many people ask me, Madam, how do you evaluate management quality without meeting them? Like since you don't meet them or talk to them personally, how can you evaluate management quality? The answer to that is I follow a comprehensive corporate governance checklist to avoid errors of commission.
Hmm.
I check for any frequent change in auditors. I check for any qualifications raised by auditors. I check for any abnormal auditor fees, or if the auditor fees are increasing at a faster pace than revenue growth. I check whether the company has got a long list of unaudited foreign subsidiaries, whether the key management personnel is drawing excessive remuneration.
Hmm.
Is the promoter holding going down? Is the promoter pledging his shares? Is there a history of excessive equity dilution?
Hmm.
What is the history of the company with regards to sharing wealth with shareholders through dividends and buybacks?
mm,
What is the credit rating report saying about the company? Are there any related party transactions?
mm,
What is the view of current and ex-employees? You can get this on mediums like Glassdoor.
mm,
What is the view of industry experts and investors whom I admire? What are their views on this particular company?
mm,
Is the promoter of this listed entity running a similar business in his privately listed company? Because that may raise conflicts of interest.
mm,
I try to evaluate accounting quality. This is very, very important. So within accounting quality, I check for any volatility in the depreciation rate, because the depreciation rate can be managed to manipulate earnings, right? So that is very important thing to check, whether the depreciation policy is stable or not. You should also always check whether expenses are being written off against the reserves and surpluses on the balance sheet instead of being routed through the profit and loss statement, because in such cases the profits are inflated. So keep that
mm,
in mind.
mm,
Also check for revenue recognition policy. I prefer managements which are conservative, and some managements are very aggressive in their revenue recognition policy, and they tend to recognize revenues earlier. This is a very prevalent practice in bull markets by shady managements. Also check the working capital cycle, the working capital intensity of the business. Is there a deteriorating or worsening trend in terms of accounts receivable days? Because that may indicate that sales are not translating into cash in the hands of the company. Also check the trend and the level of inventory days. Now here, very important point: certain businesses by their very nature and characteristic are required to stock a large high number of SKUs or stock keeping units. In such businesses, it is very routine to have high inventory days. So you cannot just look at inventory days, a high inventory days number, and just brush aside the company. It is context dependent. But in almost every case, increasing accounts receivable or very high debtor days is almost inevitably adverse indication.
mm,
So be very careful about that. I check for the historical cash flow from operations to profit after tax ratio, because this gives you a decent indication of how much of the earnings are being converted into cash. And in a commodity industry, if any one particular company has got 3 or 4 times the EBITDA margins or margins of the peers in the same industry, that should make you sit up and take notice that that there could be something wrong.
mm,
If all the peers are having suppose 10% EBITDA margins, and this particular commodity company is having 30% EBITDA margins, how could that be possible? So you should do a deep dive into such situations.
mm,
I also check for any excessive write-offs of assets in the past, and also check whether the company is capitalizing its operating expenses to smooth earnings. So a good
mm,
example here is the pharmaceutical industry. R&D is a very common expense line item in the pharma
mm,
industry, but certain companies capitalize their R&D to smooth their earnings. That's a bad practice. That is a red flag. So beyond the more conservative the management is in its accounting, the better off you will be in the long run. Also check for the health of the balance sheet and the trends in the debt to equity ratio. Check if the company has engaged in any statutory payments default in the past. Does the company have very high contingent liabilities? This is very, very important. You'll find this information in the annual report. And also check for off balance sheet obligations. Sometimes a promoter of a listed entity may give a group guarantee for all his other listed companies through one particular listed company. So check if the company has got any off balance sheet obligations as well. So if you follow this particular checklist, you will avoid most of the blow ups in the market. Now, some people may ask, what is the need to do so much work? Who looks at balance sheet and cash flow statements in bull markets, let alone footnotes to the accounts? The answer to that is, when you are in a position of fiduciary responsibility and advising other people, advising
mm,
individuals and families on investing their hard earned savings, or if you're managing their wealth, you owe it to them to reciprocate their trust in you. And that is why diligently doing your research and making sure that you include good companies in your portfolio for clients, that is why it is so important. In fact, I'll share a personal example here. Following this particular checklist helped me avoid a particular company for my flexi-cap small case portfolio. It was a specialty
mm,
chemicals company dealing in the textiles industry, and it had completed a very big capex program recently. And the management
mm,
was coming on various business channels and giving very bullish commentary. And the company had also announced very high-profile joint ventures with foreign companies in the last 6 months. So everything was looking very hunky-dory and rosy. But the moment I did a deep dive into the company's latest annual report, I found red flags galore. Even though the stock may go up during a bull market, because in a bull market, hardly anyone cares about these things eventually catch up with you in the next subsequent bear market. So do, I don't want to have anything to do with such kind of companies at all. Having worked so hard for the last 15 years to achieve financial independence, and now transitioning to the public side and advising people on their investing activity, I really don't want to deal with any bad companies, because there are enough and sufficient number of good companies in the market to build long-term wealth. So why go near the edges in the greed of quicker returns in a bull market? I don't play that game.
Got it.
Another thing which I strive to avoid as an investor is taking the short-term view, because investing is a long-term game. The more time you give it, the higher the odds of success. Traditionally, there have been three sources of advantage for the individual investor. The first one was the information edge, but with the widespread dissemination of information on the internet, the information edge is basically gone. The second source of edge has been the analytical edge, but with more and more smart people entering the investing field, the analytical edge has also got greatly compressed. But the most durable edge, in my view, which will always remain, is that of behavior and temperament. Shane Parrish of Farnham Street writes, and I quote, "People who arbitrage time will almost always outperform. The first order thought of instant gratification is a crowded path, ensuring mediocre results at best. Delayed gratification, which requires second order thinking, is less crowded and more likely to get results." In a similar vein, Howard Marks has said that rule number one, most things will prove to be cyclical. And rule number two, some of the greatest opportunities for gain and loss come when other people forget rule number one. 50 years ago, the best investors were the one with an informational edge. Today, the best investors are the ones with a behavioral edge. As the speed of information dissemination in the markets and competition for short-term outperformance among money managers increased over the years, time horizons and patience levels significantly decreased. Today, an investor's edge is less about knowing more than others about a specific stock and more about the mindset, discipline, and willingness to take a long-term view about the intrinsic value of the business. And I've talked about this particular principle in my book chapter on delayed gratification, and implementing the principles from that chapter in my book has helped me identify some of my biggest multi-baggers till date. I'll share a personal example with you, Vivek. During 2018 and 2019, the Indian auto industry was undergoing a down cycle, and an auto ancillary company named Rajrathan Global was undergoing a massive capacity expansion program. Because the entire sector was out of favor, investors' attention on that particular stock was low. But as soon as the capacity expansion got over and earnings visibility for the company went up last year, post a recovery in the auto cycle, the stock of Rajrathan Global went on to give more than 1,000% returns from that particular point, from last April. Why did this happen? It happened because of market participants' desire for instant gratification. And I've talked about the same in my book as well, and I quote, "Investors generally overlook businesses that are doing things that will create significant incremental earnings 1 to 2 years from now, because they don't want to wait that far out. Investors often shun businesses that are investing for the future and currently are suffering from low initial margins in those new initiatives, because capacity gets utilized only over time and the earnings growth is back-ended. Even if they execute well, they will see little reported earnings growth for the next 4 to 8 quarters and may even see a decline resulting from incremental depreciation and poor initial margins because of low capacity utilization. Even if they are expected to experience an exponential jump in earnings growth after that, the stock markets generally do not initially increase the market value of these businesses. They do re-rate them, however, around the time when the earnings growth is clearly visible. As investors, we get an edge over competition if we pick these companies and have the patience and conviction to hold them. Although these businesses are clearly undervalued on a longer term basis, it is psychologically challenging to invest in them and even more so to hold on to them. And these difficulties result in a lack of investors and the subsequent mispricing of these stocks, because the price discovery is weak when investors' attention on these stocks is low. And this is value investing, deep value investing at its finest. You want to buy such capex plays when they're undergoing the industry down cycle, and then hold them through the full industry cycle till the upturn is completed. and then you exit in a timely manner to reap maximum capital appreciation. This is how you get the big multi-baggers, the life-changing multi-baggers in cyclical companies in the stock market. So successful investing is all about pattern recognition. And just a few slides earlier, I'd said that the stock markets generally do not initially increase the market value of these businesses. They do re-rate them, however, around the time when the earnings growth is clearly visible. On 10th of January this year, I tweeted about a company called Ultramarine Pigments that their capacity expansion had gotten over. They were trading at a low valuation. So earnings growth and margin expansion should now lead to P re-rating. And the margin expansion would happen because the company had basically established the new capacity in the higher margin surfactants business. From 10 January till date, the stock of Ultramarine and Pigments has given more than 40% returns already. Now, I mentioned that successful investing is all about pattern recognition. In my book, I've devoted an entire chapter to pattern recognition, in which I've shared the various catalysts for re-rating through the use of management and market signals. And I'll share some of them with all our learners here. Along with the slow and gradual macro changes, investors also should be alert to tiny changes at the micro level. Be alert to tiny changes like the declaration of a maiden dividend, receipt of a large order or a landmark contract, appointment of a Big Four auditor, increased or first-time disclosures or discussion about business prospects and future plans in annual reports, presentations, or press releases, a chair or chief executive of a listed company sharing business commentary for the first time, a company holding an analyst or investor conference call for the first time, or after a long time, after many, many years, an upgrade of a company's debt instruments by rating agencies. Like I mentioned, always read credit reports. A sudden increase in the market value of a company's bonds, because bonds are always much more sensitive than stocks to changes in the economic fortunes of a company, or notable improvements or deteriorations in the working capital cycle. Always monitor the direction of the quality of earnings. Such an elaborate and exhaustive exercise requires total dedication on part of the investor, but it is highly rewarding. How? Let's use one of the patterns from this slide. I mentioned that one should always monitor the direction of the quality of earnings, because investing is all about delta, or the rate of change. Warren Buffett has very aptly said that a business should be viewed as an unfolding movie, not as a still photograph. And in investing, one should always focus on delta, the rate of change in earnings growth and its underlying quality. This is a snapshot from the annual report of a chemical company in India. This company is more than a century old. From 1919 to 2005, they were in the fertilizer business. They shut down the fertilizer business in 2005 and started focusing on manufacturing of bulk chemicals. And from 2011 onwards, they shifted their focus to specialty chemicals with an operating margin of more than 30%. And any further expansion would happen only primarily in the specialty chemical segment. Earlier this year, on 10th February 2021, the company came out with a detailed presentation on their capex plans. And as soon as the earnings visibility of this company went up post the release of this particular presentation, the stock of Dharamsi Moraji Chemicals has gone up more than 50% since that particular date. If there is one big thing that has benefited me immensely in my investing, trading, and wealth creation journey over the years, Vivek, it is this. Learning very attentively to and learning from peers, seniors, and juniors who are much more smarter and hardworking than me. One should always be very humble. The more you reach out to and associate with individuals, whether younger or older, who are better and smarter than you are, the more you will learn and the faster you will improve. It is better to be an average guy on a star team than a star on an average team. The former will be better for you in the long term. The latter is just an ego trip. The people closest to you play an outsized role in your level of success or failure. So choose wisely. You are, after all, the average of the 5 people you associate with the most in your life. The beauty of the markets today and in the digital era is that there are so many bright and hardworking investors and traders on Twitter, WhatsApp groups, and Telegram channels. And all I need to do is listen attentively to what they are sharing and then sincerely do the required study at my end. There has never been a better time to be a humble and grounded person. Ralph Waldo Emerson had said, "Every man I meet is my master in some point, and in that I learn of him." Learning and accepting help from others creates value far beyond our individual capabilities. So look at every interaction as an opportunity to learn from the people you meet. You will be amazed at how quickly you grow and how much better you become, both as a professional and, more important, as a human being. So we have to just keep learning from everyone. Let me explain the long-term virtues and how it helps us in our investing journey when we are humble and willing to learn from others. Last year, on 4th August 2020, I tweeted about watching a webinar by one of my junior colleagues, Soumya Malani, and I had noted down a key lesson from the Solera Active Pharmaceuticals demerger case study, which he had discussed in it. And on 4th August last year, I applied that same learning to RT Surfactants, which was a recently demerged listed entity, when it experienced heavy trading volume after a series of lower circuits recently. And from that day of 4th August 2020, the stock of RT Surfactants went on to give more than 700% returns before pairing some of those gains in the recent market correction. Having learned how to evaluate demergers from my colleague, I used that same learning earlier this year on 29th March when I identified Jubilant Ingravia. And since 29th March 2021, the stock of Jubilant Ingravia went up more than 200% before again paring back some of the gains in the recent market correction. Now, here I would like to share some useful information on demergers with our audience. There can be different kinds of demerger, but the big money in demergers is made in two specific cases. One is a market cap demerger, and the second one is a sectoral demerger. Let's talk about the market cap demerger first. RT Surfactants, when it got demerged from its parent company RT Industries, had fallen down to 300-400 crores market cap. And when RT Surfactants got demerged and listed as a new entity, it had residual institutional shareholding. So RT Industries, the parent company, had institutional shareholding. So when those institutions, big institutional shareholders, received shares of RT Surfactants, this tiny macro cap, they were not interested. So they just dumped the shares on the open market and tried to get whatever price they could. And the stock of RT Surfactants fell almost 50% from its post-demerger listing price because the institutions were in a hurry to just dispose of this tiny macro cap, which they had got as a result of holding RT Industries pre-demerger. So this is an example of a market cap demerger. This is how you get forced selling and bargain opportunities in market cap demergers. The second example is that of a sectoral demerger. So Jubilant Ingravia and Jubilant Pharmanova both got demerged from Jubilant Life Sciences. And Jubilant Life Sciences was primarily held by pharmaceutical mutual funds and pharma funds. So even though Jubilant Ingravia was a decent chemicals business, it was listed at a decent respectable size market cap, still it got sold by all those pharmaceutical funds who, by their rigid institutional mandates, were not allowed to hold a chemicals company in their mutual fund portfolios. So the big money in demergers is made when there is forced selling. And forced selling happens only in two cases: market cap demerger or sectoral demerger. So I'll just share a example for the next year in advance. So RT Industries is also going to hive off its pharmaceuticals business next year. And in that situation, you may again get a sectoral demerger because RT Industries is held by a lot of chemicals mutual funds, chemical themed mutual funds. Next year, when those institutional investors will receive the demerged shares of the pharma business from RT Industries, they will not be able to hold on to that particular stock. They will have to compulsorily dump it and sell it at any price they get because they are not allowed to hold a pharma share. If you are a chemicals fund, then you cannot hold a pharmaceutical company, right, in your portfolio. So again, a similar situation, a sectoral demerger may play out next year in the case of the RT Pharmaceuticals demerger from RT Industries.
Sure. Gautam, one question for this. Let's go back to the previous slide. Tell me, anyone who would have played this story would be a demerger story, right? So people would have bought it. But then obviously price has corrected. I think maybe because it could be a price-based correction, it could be time-based correction also, that it has to correct. Someone who is holding the stock from a demerger perspective, when would that person sell this stock?
Good question. So there are two ways to exit these demerger stories. Number one, so first, if the company is a secular growth company, then you can ignore the temporary price corrections. You can just hold on for the long term. Okay. But if it's a cyclical business, which had got beaten down to ridiculously low valuations, and if it is simply experiencing mean reversion and coming back to fair value, in those cases, you can make use of what I call techno-funder principles. You can make in my book, I've talked about, you can use a moving average of your liking to protect and conserve your profits, like a 21-day moving average or a 50-day moving average or a 200-day moving average. So those are multiple exit criteria which you can use you can put in place in case of demergers involving cyclical companies.
Sure.
But in certain cases, you may get a very high quality, long term structural growth story. In those cases, you don't have to worry too much about technicals. You can just hold on for the long term and create wealth. But many times in demergers, you'll see that I'll give you a good example. Next year, the stock of Aarti Pharmaceuticals will get demerged from Aarti Industries, and Aarti Pharmaceuticals has got a very good US FDA track record. They have got a very big capacity expansion program in place. They have got a good track record of revenue growth in the past. That's more of a structural long-term story. So in that case, even after the demerger, even if you buy it at a depressed price, you make your mean reversion returns. You don't have to sell it immediately if it undergoes a price correction for the short term. So when you exit depends when and if you need to exit depends on the underlying business.
Sure.
Jubilant Ingrevia was a cyclical business. Similarly, Aarti Surfactants was a mediocre quality business, but it just had gotten beaten down to a ridiculous price. So that's why you were able to make the big gains. But in case of cyclical companies, you should have a clearly defined exit criteria in place and follow. See, any system that you're able to stick to for the long period of time, that is the system you should basically just stick with. Just don't keep changing your systems and processes during every phase of the market in every kind of situation. Have a clearly defined exit criteria, entry criteria, and portfolio management system in place, and then follow it diligently. And over time, you evolve, adapt, and learn more as an investor. But at all points of time, do have some clearly defined criteria for your entry, holding, and exits in place.
Sure. Point taken.
So earlier in the presentation, I talked about promoter and management change as a special situation. Right now, I talked about a demerger as a special situation. But the ultimate kind of special situation is one involving demerger plus promoter change. So in September, just a few months earlier, Advent, the private equity giant, announced the acquisition of the Eureka Forbes business from Forbes and Company, whereby the Eureka Forbes business of water purifiers and vacuum cleaners would get demerged from Forbes and Company, and Advent would become the majority owner of that new business, Eureka Forbes. And what was the reason for this particular transaction? Let's understand the background here and how you can get attractively valued and fairly valued opportunities even in a bull market. The owner of Forbes and Company, Shapurji Pallonji Group, had a total debt of more than 20,000 crores as of September 2021. And they sold the Eureka Forbes business to Advent for 4,400 crores to help pay down some of their debt. So Advent now gets access to the crown jewel asset, the crown jewel business of that particular group at a fair price. And as a public market investor, you also get to participate in this particular transaction at a fair price by playing this particular demerger. And how are you stacking the odds of success? Again, go back to the point on stacking the odds and the probabilities in your favor. How are you doing that in this case? First of all, you're paying just a fair price. You're not paying a very high price. These kind of consumer brands with high market shares tend to trade at very, very high price to sales multiples. Symphony trades at 7 times price to sales multiple. Whereas after the demerger, I think, as per my calculations, Eureka Forbes would not be even a 2 times price to sales multiple. And secondly, Advent, the new owner, has already got an established past track record of turning around consumer companies in India. It has already got a very strong track record in the form of the successful takeover of Crompton Consumer. So again, the odds are coming on your side. You're paying a fair price. You're getting a new owner, a new promoter with proven track record in that particular industry, and you may also benefit from valuation multiple re-rating. So again, you're putting multiple forces in your favor. That is how you ensure long-term success as an investor. So what is the big insight that we get from all these case studies? It is that all intelligent investing is value investing. And if I had not self-educated myself on different areas of value in the market, like demergers, merger arbitrage, cyclical commodities, high quality secular growth, and instead restricted myself to only one way of investing, then I would have never been able to participate in broad-based bull market. And always remember, sector rotation is the hallmark characteristic of a true bull market. If the sector rotation is not happening, then it is not a bull market. Bull markets are very, very broad-based. And my personal investment opportunity set has significantly expanded over the years with time and experience in the markets. I started with looking at low price to earnings and low price to book stocks because I started by reading The Intelligent Investor by Ben Graham. Then I read about Warren Buffett and Phil Fisher and Charlie Munger, and then I started investing in secular growth stocks at reasonable valuations. Eventually, then moving to fair valuations and then expensive valuations. But now it covers multiple areas of the investment universe, including commodities, cyclicals, deep value and spin-offs, and turnarounds. Instead of being restricted by my personal biased views to a small opportunity set, as was the case in my early years, I am now able to invest in a variety of situations and industries wherever I find mispricing of value and a highly favorable risk return trade off. You see, no single strategy works all of the time and in every kind of market. And that is why it is essential to build up one's investing arsenal to be able to hunt for value from within different areas. And over the years, I've come to realize and appreciate just why this is so critically important. It is because a bull market is always going on at all points of time in some specific sectors of the stock market. Between 96 to 2000, it was technology, media, and communications. Between 2003 to 2008, it was infrastructure, commodities, real estate, and organized retail. Between 2009 to 2014, it was discretionary consumption, pharmaceuticals, IT services, and FMCG. And between 2015 to 2019, it was autos and financials like NBFCs and microfinance companies. And from last year, a new trend, new bull run has emerged in import substitution. So we have got specialty chemicals and multiple subsegments within India's manufacturing industry, CDMOs, CRAMs, contract research and manufacturing, and contract development and manufacturing organizations, digital transformation, cloud computing, e-commerce. Real estate is undergoing a upcycle. So you can play this through building materials and housing finance companies. The government's favorable policies for ethanol blending have also led to a upsurge in that particular sector. And if you want to look for if you want to look for value, you can look for sectors where no supply has been seen in the last 10 years, like commodities or real estate. It is my personal conviction and belief that the opportunities in the next 20 years in India will be far greater than those in the past 20 years. And the opportunities of the last 20 years will be dwarfed by the opportunities of the next 20 years. And where will those opportunities come from? They'll come from two sources: variant perception and long-term structural trends. Variant perception refers to situations in which you get an ROC expansion plus earnings growth plus valuation multiple re-rating, and you end up with multi-baggers. And variant perception comes from having a differentiated view on the short to medium-term trajectory of the business. There are multiple triggers for variant perception, starting with product mix change in higher margin products, which can lead to margin expansion and higher ROC. It can come from a big capex program which has recently got completed. It can come from operating leverage through the newly installed capex. It can come from an industry cycle shift, like we saw in the real estate cycle since last year. The industry cycle has shifted to the upside. Variant perception can also come from a favorable regulatory change. It can come from deleveraging of the balance sheet and debt reduction, because as debt goes down, interest costs go down and net profit goes up, market cap goes up. It can also come from improvement in asset turns. You can get this information on the expected asset turnover on the new capacity in conference calls. And ROC expansion comes from two sources, right? Improvement in margins or improvement in asset turnover. Between the two, I prefer improvement in asset turnover because high margins tend to attract competition. Variant perception can also come from corporate actions like demergers, reverse mergers, promoter or management change. It can also come from divestiture of a loss-making business. So it's very simple. If a listed company sells off a loss-making business, then the company's net profit after that divestiture goes up. And if the net profit goes up, the market cap also goes up. Similarly, many companies have or suffer from what is known as a conglomerate discount. They basically are a collection of multiple businesses, and they have one single core business, and then they have a few other non-core businesses. So the moment they divest the non-core business, the perception of the market for that company improves, and the company gets a valuation re-rating. So this was all about variant perception. Long-term structural trends are found in industries having a very favorable structure. They are either organized in the form of monopolies or oligopolies, and they are generally experiencing some form of an industry tailwind. They have consistency and predictability of cash flows. They have a long runway for growth. So you have high visibility for many years ahead. They are characterized by value migration, for example, from unorganized to organized or public to private. And some of the structural growth plays are CDMOs, CRAMs, contract manufacturing, specialty chemicals with critical application, animal healthcare, fintech, music streaming, e-commerce, digital transformation, and cloud computing. Stellar Wealth FlexiCap small case is based on varied perception, and Stellar Wealth Mega Trends is based on long-term structural trends. Both are benchmark agnostic portfolios of 25 to 30 stocks with no rigid market cap constraints. And in case anyone is wanting to know the rationale for having 25 to 30 names in both these portfolios, it is because of this. 25 to 30 names is the optimal number of holdings to maximize the risk return trade off. As per a study published in the international bestseller, A Random Walk Down Wall Street by Burton Malkiel, as the number of stocks in a portfolio reaches 25 to 30 names, the incremental volatility reducing benefits of diversification reach near zero. So, this is the sweet spot for an active investor seeking to outperform the market. At 25 to 30 names, you have captured almost all the benefits of diversification, yet the number of companies you need to know thoroughly is still manageable. I would like to conclude my talk today with a brief about how value investing, in my opinion, resembles and is actually a life discipline. Investing, Vivek, is a field of competitive learning, and to succeed in this particular profession, you have to outlearn the rest. That is how you'll get ahead in this investing profession. In August 2016, Michael Mauboussin authored a brilliant paper titled 30 Years Reflections on the 10 Attributes of Great Investors. And in one of my past interviews published on the Stock and Ladder blog, I had talked about those 10 attributes and also suggested a list of the best books on each of those 10 attributes. So I'll just share those 10 attributes for the benefit of our learning community. Numeracy, understanding value, probably properly assessing strategy, comparing effectively, probabilistic thinking, updating our views effectively, beware of behavioral biases, know the difference between information and influence, position sizing, and reading. And I'd also added three more important attributes to Michael Maubussin's list: extreme levels of patience, coupled with the ability to act decisively when the no-brainer opportunities present themselves, multidisciplinary thinking, and inversion. In investing, all knowledge is cumulative. Nothing goes to waste. Nothing goes to waste. The hard work which you're putting in today will pay off in the form of good luck in future. But you have to have faith and just keep learning all the time. Benjamin Franklin very beautifully said that an investment in knowledge pays the best interest. In a similar way, Warren Buffett has also said, the more you learn, the more you'll earn. The best investment you can make is an investment in yourself. The value investing discipline has certain finer aspects that we come to realize and appreciate only with the passage of time and with experience. With the passage of time, we learn to recognize that value investing is not merely about stocks and business fundamentals. It is a life discipline. And I've talked about the same in my books section on overrated and underrated behaviors, and I'll share a few of them with you. Knowledge is overrated, wisdom is underrated, intellect is overrated, temperament is underrated, outcome is overrated, process is underrated, forecasting is overrated, preparation is underrated, confidence is overrated, humility is underrated, conviction is overrated, pragmatism is underrated, complexity is overrated, simplicity is underrated, analytical ability is overrated, personal behavior is underrated, having a high income level is overrated, inculcating a disciplined saving habit is underrated, competition with peers is overrated, helping them is underrated, large personal net worth is overrated, good karma is underrated, talent is overrated, resilience is underrated, being the best investor is overrated, being the most authentic version of yourself is underrated. I'll end with two key messages from my book: that the goals of investment should be happiness, joy, growth, intellectual satisfaction, and eventually peace and serenity. Wealth and financial prosperity are natural byproducts of lifelong learning. And many people achieve success, but to sustain the same and potentially build on it over an entire lifetime requires humility, gratitude, and a constant learning mindset. For any feedback or queries, feel free to connect with me on stellarwealthpartners.com. I can also be reached on LinkedIn and Twitter. You can learn more about my chapter on investing at getchapter.app/Gautam. Readers can get their copy of the book on Amazon, Google Play Books, and Book Depository website. You can also drop me an email at info@stellarwealthpartners.com. With that, I come to the end of my presentation. Thank you, Vivek.
Awesome, awesome. So, Gautam, you are one of those people who exactly know what they're doing, and they also exactly know what others should do and communicate the right way. And your book is testimonial of your clarity. I would recommend everyone to, and I've already done that, and no commercial interest with Gotham. Neither we are affiliate, nor there is any small case affiliation of mine, but I simply love what he is doing. So everyone should read the book. Please do not read ebook or the pirated copies. I request everyone, you will not get the sense of the the wisdom which he is giving by downloading some PDF and reading somewhere. It has to be either the physical book or Kindle or whatever you think is the right source. But never, never do piracy for all this amazing knowledge people are sharing with us. So, friends, this was Gautam. Feel free to connect with him. He's very approachable person. You see, I approached him and he readily accepted this. So he's there on multiple forums. Twitter, I find him to be very active. So if you have any follow-on query, feel free to connect with him. But by the way, if you read that book, a lot of queries will get anyways answered. So first read the book, and if you feel anything left, then you can connect with Gautam over his email or his Twitter handle. Just small thing, Gautam, I would request we may see a lot of people asking follow-on questions in this YouTube video below as a comment. So if you can pick some of them and reply to their comments, I know you will have a very busy schedule, but if you can pick some of them and reply, that will add value. Or later we can do some kind of a free Q&A session for our learners where they can ask the questions and I can host that as ELM live and we can answer those pending questions if they have any.
Yeah, that sounds pretty good, Vivek. Sure.
Great, great, fantastic. So thank you so much, Gautam, and thank you, friends, for watching this video till the end. As Gautam said, that good karma is underrated, and if you really want that rating to go up, you share this video. The more you share, that means the more you care, and you get more karma for yourself. Thank you. Bye bye. Take care.